Bitcoin just crossed 111K. Oil crashing to 6-month lows. And this week, 3 tech giants are about to reveal whether this entire rally has been built on sand or solid ground. If you own stocks, crypto, or literally anything, the next 5 days could redefine the rest of the year. The volatility index just dropped 18% in a single session. But is that confidence or complacency? We're going to find out. Stay with me because I'm going to break down 7 critical market moves happening right now. And there's going to be in the description timestamps for you to jump to any segment that you want to know about. Welcome back to StockScope Live. I'm your host, Ali, and today we're diving deep into what might be the most consequential earnings week of 2025. Here's what's happening. The S&P 500 opened up 0.5%. The Nasdaq climbed 0.65%, and on the surface, everything looks calm. But beneath that calm exterior, we've got a perfect storm brewing. Tesla reports on Tuesday. Netflix drops numbers on Monday. Intel follows on Wednesday. These aren't just any companies. They represent nearly $2 trillion in combined market cap. And their results will either validate current valuations or expose them as fantasy. But it's not just about earnings. We've got the VIX, the fear gauge, plummeting 18%. We've got crude oil collapsing below $57 a barrel. Bitcoin dancing above 110K, while whales quietly dump billions. The U.S. government shutdown is entering week 3, and the Fed is almost guaranteed to cut rates in 8 days. So here's what we're covering today. First, why this earnings week matters more than any other this year. Second, the commodity shakeup, why oil is tanking and gold is pausing after a historic run. Third, crypto divergence that's confusing even experienced traders. And fourth, the global macro picture from China's GDP miss to Japan's political earthquakes. Let's get right into it. All right, let's start with the main event, earnings season. Netflix reports after the bell today, Monday, October 21st. Wall Street expects earnings per share of around $6.89 on revenues of about $11.52 billion. That's a 30% year-over-year earnings growth. Impressive, right? Here's the catch. The stock is already up 32.7% year-to-date, and the market is priced for perfection because Netflix raised its full-year revenue guidance between $44.8 to $45.2 billion, which is a positive signal. Their hit series K-pop Demon Hunters, for example, pulled in 500 million viewing hours in Q3 with another 400 million expected in Q4. The question isn't whether Netflix will beat. It's whether they'll beat by enough to justify a valuation that's already stretched. If they miss on subscriber growth or give weak forward guidance, you're going to see a 10 to 15% haircut overnight. We've seen it before. Now, let's move on down to Tesla. They're reporting on Tuesday, October 22nd. And this is where it gets really interesting. Tesla delivered a record 497,099 vehicles in Q3, beating Bloomberg's consensus. That sounds great until you look at the profit picture. Analysts expect earnings per share to drop 24% to just around 55 cents. Now, why is that? Because U.S. tax incentives for EV buyers expired, and that's a direct hit to margins. Wells Fargo analyst Colin Langan came out this week warning there's too much hype baked into Tesla stock. The NHTSA is investigating the full self-driving feature after multiple crashes. The robo-taxi business, which Elon keeps hyping, is still years away from meaningful revenue. But here's the other side. Tesla has cult-like investor royalty, and the stock has defied gravity for years. If they guide even remotely optimistic on the Cybertruck ramp or energy storage growth, the stock could surge 15 to 20%, regardless of the earnings miss. This is a binary event. You're either positioned for it or you're not. Then we got Intel. On Wednesday, October 23rd, they're going to give out their earnings. And this is a comeback story of 2025. Intel shares are up 92% year to date. Why? Well, there's three massive deals. $5 billion investment from NVIDIA, $8.9 billion from Trump administration, that's roughly a 10% stake, and $2 billion from SoftBank. Plus, they launched a new AI chip specifically for data centers, competing directly with NVIDIA's H100 and H200 series. The market is betting Intel can reclaim its manufacturing edge with these partnerships. But here's the risk. Intel has missed earnings in 5 of the last 8 quarters. Execution has been their Achilles heel. If they stumble on guidance or show weakness in their foundry business, all that 92% gain could evaporate in days. The bottom line on earnings this week separates the real growth from the hype. If these three companies, Netflix, Tesla, and Intel, deliver strong results with confident guidance, this rally extends into year end. If they disappoint, we could see a 5 to 10% correction across the NASDAQ. So make sure you position accordingly. Number 2, let's talk about what's happening in commodities, because this is equally important. WTI crude oil just fell below $57 per barrel, down to $57.36 on Friday. That's a 6-month low, and this marks the 3rd consecutive weekly decline. Why is oil tanking? Well, there's 3 reasons. First, oversupply. The International Energy Agency raised its 2026 surplus projection by nearly 20%. OPEC Plus members are cheating on production cuts. Libya, Nigeria, and even Saudi Arabia have increased outputs. Meanwhile, U.S. production hit a record 13.636 million barrels per day. There's simply too much oil. Number 2, demand weakness. China's economy grew 4.8% in Q3, below the 5% level needed to sustain strong oil demand. The property crisis there is still unresolved. When China sneezes, commodity markets catch a cold. Third, geopolitical calm. The Middle East tensions have cooled significantly. Israel and Hamas are honoring a ceasefire, as far as we can tell. That removes the risk premium that had been supporting oil prices earlier this year. Now, here's what this means for investors. Energy stocks are getting crushed. If you own Exxon, Chevron, or Canadian energy names like Suncor, you're feeling the pain. But, flip side, lower oil prices means lower inflation, which supports the Fed cutting rates. It's a bit of a mixed bag. One more thing on oil. You got to watch for the U.S.-China trade talks that's happening this week. If Trump and Xi make progress, we could see a sentiment shift that lifts crude. But fundamentally, oil looks weak into 2026. Now let's move on to precious metals, gold and silver. Gold hit an all-time high above $4,300 per ounce earlier last week. Silver breached the $50 mark for the first time in decades, hitting about $54.35. Both have pulled back slightly but remain elevated. Why did they surge? Let's talk about the debasement trade. The U.S. government debt is exploding. We talked about it in few videos. The shutdown, now 19 days long, has highlighted fiscal dysfunction. The Fed is cutting rates while inflation risks persist. Investors are fleeing bonds and piling into tangible assets. Now, Goldman Sachs, HSBC, and Bank of America all raised their gold price targets. B of A sees $6,000 per ounce by spring 2026. That's another 40% upside from current levels. But here's the caution. Silver saw record consumer selling. Retail investors who bought at 50 plus are now dumping. If gold loses momentum, silver could fall 20-30% in a matter of weeks, because it is more volatile than gold. My take, gold remains a core portfolio hedge, especially with the Fed cuts coming. But don't chase silver at these levels unless you're comfortable with huge swings, because there is the risk reward has shifted for silver. Commodities are telling us something important, and this is important to understand, because the global economy is slowing. Inflation is moderating, and central banks have room to ease. That's a Goldilocks scenario for stocks. but only if earnings hold up. Third, let's shift to crypto because what's happening here is fascinating. Bitcoin is trading above 111K, up 2.9% on the day. It's consolidating in the 111 to 115K range after a sharp correction earlier. On-chain data shows whales are quietly reaccumulating. But this is a big but. Options market data shows persistent put bias. Traders are hedging downside risk aggressively. And that tells you smart money is nervous. Here's the kicker. Between October 12th and October 14th, sharks and whales sold 17.5 thousand Bitcoin, roughly worth about 1.9 billion. Long-term holders have seen net outflows of about 265,000 Bitcoins over the past 30 days. That's the largest exodus since January. So Bitcoin is going up, but the strongest hands are selling. What does that tell you? This is the distribution phase. Because now you can contrast that with altcoins like XRP and Solana are showing bullish option signals. Traders are buying calls and expecting upside. The sentiment divergence between Bitcoin and altcoins is the widest we've seen in months. Why? Because of risk rotation. When Bitcoin consolidates or shows signs of topping, speculative capital flows into higher beta altcoins, chasing bigger percentage gains. We saw this in the late 2021 before the crash. We saw it again in early 2024. Analysts are projecting Bitcoin could close 2025 between 120 and 150, with potential spikes to 180, if institutional inflows continue. But those are the best case scenarios. Here's my framework. If Bitcoin breaks and holds 115, the next target is 125. But if it fails to claim or reclaim 115 and breaks below 108, we could see a flush down to 95 to 100. For altcoins, I'd wait for clearer confirmation. XRP looks interesting if it breaks above 265. Solana needs to reclaim 160 to invalidate the bear structure. The bottom line on crypto is the market is split into two forks. Bitcoin is institutional. It's slower and steadier. Altcoin is retail speculation. Faster, riskier. You need to know which game you are playing. All right, finally, let's zoom out and look at the global macro picture, because this sets the stage for everything else. The US dollar is weakening. The dollar index is trading around 98.4, while the euro climbed back up above 1.17. Over the past 12 months, the euro has gained more than 6% against the dollar. And why is that? Number one, the government shutdown. Key economic data like the non-farm payrolls have been delayed, and markets hate uncertainty, so the dollar is paying the price. Number two, the Fed rate cuts. Everybody's expecting 100% cut on October 29th, and now they're expecting 96% cut on December. The rate differentials are narrowing, and when the US yields fall faster than European yields, the dollar obviously takes a hit. Lastly, the confidence. Tariffs, debt sustainability concerns, potential political interference with the Fed, all this shit is gradually eroding faith in the dollar as a stable reserve currency. Now, BNP set a 3-month Euro USD target of 1.16 and a 12-month target of $1.24. If that plays out, the euro could gain another 6 to 8% from here. And what does a weaker dollar mean? Well, it's bullish for commodities priced in dollar, like gold and oil. But it's bearish for US exporters and multinational corporations that earn revenue overseas. Now let's move on over to China, because China had a third quarter GDP at 4.8 year over year, slightly beating expectations, but it's slowing down from the Q2's 5.2%. Their industrial production surprised us and had an upside at 6.5% versus 5%. Retail sales met the expectations of about 3%. Now, the property crisis is still dragging on growth. Stimulus measures announced in September helped stabilize sentiment, but they haven't reversed the structural decline in real estate. Here's what matters. China represents 18% of global GDP. If they can't hit 5% growth, global commodity demand suffers, emerging markets struggle, and multinational companies miss revenue targets. But here's the silver lining. US-China trade talks are happening this week. So President Trump and President Xi are expected to meet later this month. Trump tried to calm markets in a Fox News interview, saying, quote, "I'm not looking to destroy China," end quote, and expressing confidence that we're going to be fine with China. If those talks produce even a minor de-escalation, like rolling back some tariffs or committing to future negotiations, you're going to see a massive risk-on rally. Chinese stocks, emerging markets, commodities, all would benefit. And finally, let's talk about Japan. The Nikkei surged more than 3% to a new record above 49,000 points after the Liberal Democratic Party formed a coalition with the Japan Innovation Party. This paves the way for the Takashi to become Japan's first female prime minister. Investors are anticipating proactive fiscal policies. Basically, Abenomics 2.0, more government spending, potential monetary easing, corporate governance reforms. Japanese equities have been on fire, and this political stability adds fuel. If you're underweight Japan, finally, let's talk about Japan. The Nikkei surged more than 3% to a new record above 49,000. Now, this came after the new coalition between the Liberal Democratic Party and the Japan Innovation Party. This paves way for the first female prime minister. Investors are anticipating a proactive fiscal policy, meaning more government spending, potential monetary easing, and corporate governance reforms. Japanese equities have been on fire, and this political stability will add fuel. The global macro summary is the dollar weakness is creating opportunities in international markets. China's slowdown is a headwind, but manageable if trade talks succeed. Japan is the surprise outperformer. Keep your portfolio globally diversified if you have access to those markets. All right, thank you so much for watching till the end. Let's bring it back all together. This week is critical. Netflix, Tesla, Intel earnings will determine whether tech valuations hold or crack. Oil collapse and gold pause signal a slowing global economy, but also give central banks room to ease. Bitcoin's consolidation above 111 looks bullish, but whale distribution is a warning sign. And the Fed rate cut in October is almost guaranteed, but the real question is what they signal for December and beyond. Here's what I'm watching. Monday night, Netflix earnings. They need to beat on subscribers and guide strong. That's bullish for tech. Tuesday, Tesla earnings. Watch for guidance more than the print. Wednesday, Intel earnings and any update on AI chip rollout. Thursday, Friday, US-China trade headlines. Any positive sound bites could spark a rally. Now, I want to hear from you. Which stock earnings are you most nervous about? Are you buying the oil dip or are you staying away? Do you think Bitcoin hits 120K by year end or crashes to 95? Drop your thoughts in the comments below. I read every single one and I respond. If you found this breakdown valuable, smash the like button. It tells YouTube to share this with more investors who need to see it. And if you're not subscribed yet, hit the subscribe button and turn on notifications so you never miss an upload. I post daily and we talk about a range of things like market analysis, stocks, and macro breakdowns. We're building a community of informed investors who don't just follow the herd. They understand why the market moves. Before you go, quick reminder, none of this is financial advice. I'm sharing my analysis and research, but you need to do your own due diligence, and you should consult a licensed financial advisor before making investment decisions. Markets are unpredictable. Earnings can surprise, geopolitical events can shift overnight. And the goal of this channel is to give you the information and context you need to make smarter decisions, not to tell you exactly what to buy or sell. That said, I genuinely believe this is one of the most important weeks of 2025. The next 5 days will set the tone for the final quarter of the year. So stay sharp, stay informed, and don't let emotions drive your portfolio. We're going to come back and do a follow-up at the end of this week to see how things went. Until then, stay diversified, stay safe, and I'll catch you in the next video.